Well, there are, I'd say, two strong markers for 2023. The first one is indeed that in developed economy, we will have lesser economic growth in 2023 than we have in 2022. And that is true for the US and for Europe. The main question is not if we will have a recession, is when it will happen and how deep this recession will be. Why that is? Because the action of central bankers have been very tough, very active, very aggressive, and now the effects of those higher interest rates are started to be felt. It's weighing on credit growth, it's weighing on investments, it's weighing on capex, and this will have an impact on demand and hence will have an impact on growth. So that's one important marker that investors have to integrate when they deploy their assets in 2023. The second important marker for 2023 is that when we look at another very strong economic bloc across the world, which is China, well, in China we will see better economic growth in 2023 than we had in 2022. And this diversification, those differences between those main economic regions is clearly a source of opportunity for investors. Well, there's a bit of both. One very strong contributor to inflation since the mid of 2021 has been the very upward move we have seen on commodities. This has been pushing inflation to double digits up to last year, and the effects of those very high commodity prices is going to go down on inflation. So that's one important factor. So in this economic growth environment, or lesser economic growth environment I was describing, we will be embarking in this disinflationary trend, which is true in the US and in Europe. So that's one contributor. But the main question for inflation is when we're looking at the most sticky part of inflation, the most persistent part of inflation, what we call core inflation, inflation which is not linked to commodities or to food-related products. And this core inflation is much more linked to services, to wages as well. In the US, we have already seen the peak in core inflation. It's going down, not as rapidly as people think, and we will likely need to have a recession to have this inflation coming back to this 2% target. In Europe, the situation is a bit different because the high point in inflation, in this core inflation, is not expected to happen until the summer of 2023. And this will have implications, and notably implications in terms of monetary policies, and this means that while the Federal Reserve has likely reached its peak, or not too far from its peak in monetary policies and in interest rates, the European Central Bank will likely continue to hike rates at least 2 to 3 times for the remaining of 2023. Well, this environment I was describing is a very complex one. Why that is? Because we have this decoupling between the developed world and China. So this requires very active management. Likewise, this divergences we're seeing in economic growth trajectory is also being fed into monetary policies trajectory, which are also quite divergent, as I mentioned. Fed not too far from the top, the European Central Bank continuing to hike rates, while in China, the central bank is lowering interest rates, which is also commanding for active management of those different blocks. So how do we view things and how are we deploying assets within Carmignac? We think that on the equity side, with the risk of recession approaching, with the risk of a hard landing being present, not the central scenario, but being present, it's important to focus on what we call quality equities, on companies which are quite resilient, not too dependent on the economic cycle, and do not have too much debt because interest rates are quite high. On the equity side, there's lots of value in being diversified. As I mentioned, economic growth in China will be better in 2023 than in 2022. And all else equal, nominal economic growth feeds into companies' earnings. So there's, again, lots of value in being invested in Chinese equities and maybe much more exposed to the Chinese cycle. On the fixed income side, then again, 2022 has been very difficult for fixed income investors, but today we have levels of yields of interest rates which are much higher than when they were last year. And what does this mean? It means that there's, again, much more value in being invested in risk assets, so some equities, even though in a cautious way, and to be invested in what we call duration, in bonds issued by well-rated issuers, because they have a protective value again. If indeed the economic environment is worsening, well, the interest rates on those bonds will fall, and hence the price of those bonds will go up. So we clearly believe that active management is the name of the game in 2023, and that flexible multi-asset portfolios should fare very well in this environment.